218. Nifty Bank is nothing, almost unchanged, but slightly in the red. The Sensex is unchanged. It's okay. Nifty Bank is down 0.17 now, but these are very, very flat and sort of nothing kind of rates. IT index, one of the bigger ones, absolutely flat. IT, the index was up 2% yesterday on the back of all those earnings and very strong mid-cap reactions. 20 points now on the Nifty, more up than down, as you can see on the Nifty heat map as well. Surbhi.
Yeah, I was just looking at the accident of the morning. Has to be Cyient. CEO is exiting. They've cut the guidance. They're saying growth could actually fall by 2.7% in FY25. Market just doesn't like that, given how strong a lot of the other mid-cap IT companies have been. So Cyient is dealing with a problem right now. Anyway, on the large cap screen, what's working well is BPCL. By the way, HPCL's numbers have been well received and seems to be rubbing off on BPCL as well. That's a stock which is in the Nifty winner right now, 2% higher. Other names include Coal India, JSW Steel. There's Shriram Finance, which is up about 1%. Some buying on Eicher Motors. A few large names like SBI, Reliance, ICICI Bank on the upside of the screen for now, but nothing to write home about. Even Axis Bank is up, but let's see. It is looking a little tricky at the start. Dr. Reddy's is straight away down 5%. Disappointment there. 9% down quarter on US sales. The market doesn't like that. Then there is Apollo Hospitals, some profit taking on Maruti Suzuki, Trent, Cipla, Sun Pharma. Actually, all of pharma seems to be down to begin with. Nifty up about 46, 47 points, and that's on the hope that some of the larger banks will stay afloat.
Well, that's right. Surbhi, let's bring some good news first. KFin Tech, the EBITDA numbers up by 30%. Revenue has jumped up by 30%. Stock has seen a sharp correction from the recent peak. It wants to bounce back. It's bouncing back. Thyrocare. Stock went to around 1,000 rupees, pulled back big time. The numbers look pretty good, and they are on their way with regard to the recovery. So the EBITDA is up close to around 30% or thereabouts. The margins have expanded now to around 25%. We pull up a chart last few quarters that margin improvement is something the street likes. So that one as well is bursting away. Jyoti Structures, it seems that one is up. I think it's locked close to around 10% as we speak with regard to that order win, 740 crore order win from Power Grid. So the street likes that. The door is shut on the other end with regard to Cyient. It's down 10% and pending sell orders out there. So the performance wasn't great. Resignation at the top. Street very, very nervous on that one. Tejas Networks, that's down close to around 8%. Remember, some of these stocks saw a one-way move. And now, in fact, with numbers not coming about, the street doesn't like it too much. EBITDA down 30%, margins contracting to around 14%. So that's one of the big casualties early this morning. And Go Digit that did well, in fact, yesterday. That stock, in fact, is pulled back close to around 3.5%. And by the way, as we were doing that check, United Spirits a little bit tipsy today. The start was in the green, but that stock has pulled back right now. And if I saw it correctly yesterday, towards the end of the trade, there was some pre-buying. Yeah. So that's why the pre-positioning actually is hurting the stock. As Manglam said, no worries on that front. But it's a good start. We're 400 points away from that crucial level of 23,650. The bulls would like to end higher than that in the next 5 sessions to avoid the fourth straight month that we end in the red.
All right, 23,275, so 70 points higher. Slow and steady ticking up, essentially, is what we have going on at this point in time. So, this is decent. Can live with absolutely with these kind of prices. Hopefully, it stays and maybe builds from here out. So, there's a fair bit to track. So, I'll come back to individual stocks, etc., in a bit. But let's welcome in Karthik Kumar, fund manager at Axis Mutual Fund, who's with us as well. Karthik, good morning. Great to have you with us here on the program. Thank you for your time. So, what's the broad makeup at the Kotak team? I mean, is it one of risk aversion? Is it one of hunting for opportunities and looking at what to buy, whether it makes sense, that makes sense, or I mean, just the mental makeup right now?
So effectively, what we are seeing right now in terms of style, if I were to break it down in the markets, is that lower risk and value in general is holding up well. And even within value, if you were to kind of dissect it down, it's low value is not getting, like cheaper stocks are not necessarily getting rewarded, but costlier stocks are getting penalized in the markets. And the other way to look at it is, as you mentioned briefly before as well, which is higher growth stocks. And so growth stocks and momentum stocks are taking the hit as well. during the course of the correction over the last couple of weeks. So that's what we are seeing from a style perspective in the markets.
Karthik, right now, are you fully deployed or is there some cash on the side? And what's the broader strategy that you're adopting, given that we're in really choppy waters, too much news flow, there's a budget coming up, and a fair amount of price damage has already happened in large parts of the market?
That's much more specific to schemes and the kind of strategies we are running. So I think that would have to be taken up at a scheme level or at a strategy level. But in my case, I'm still running the portfolio largely deployed. Obviously there are changes in positioning, and we kind of constantly evaluate to see which place is the best to stay in, given the nature of these markets. But as far as I'm concerned, I'm largely deployed.
Which is what I'm asking. The broader strategy framework right now, in terms of the models that you're following, what exactly are you doing in a market like this, and what's the advice?
So in terms of where we are seeing earnings upgrades, we are seeing earnings upgrades in pharma. We are seeing earnings upgrades in some of the selective discretionary space. And we are still seeing earnings upgrades in some of the select industrials names as well. So in terms of our overweights, we are much more aligned towards that. Whereas a large part of the earnings downgrades is where we are seeing in selective consumer staple names, and the metals and commodity names in general continue to see pressure as well. So that's how I'm positioned from a sector perspective, where I'm overweight healthcare and selective consumer discretionary place, whereas I'm underweight energy, commodities in general, and staples as well.
All right. Hi, Karthik. Good morning and good to see you. And Karthik, what about consumption? I recall we chatted about this in the past, and I think you were hinting that maybe it's time to start nibbling in. How are you all placed on the consumption theme, and what do you like out there, staples or discretionary?
Still prefer discretionary over staples. That's been the case for some time now, and I'd still stick to that. Discretionary, within discretionary, extremely selective as well. At least in my case, we have exposure to two-wheeler, some of the two-wheeler names, some auto ancillaries, selective consumer retail exposure place, discretionary retail exposure place. That's where our exposure is. And on the staple side, it's extremely selective. Less of the benchmark heavyweight names, and some of the less heavyweight names from a sector perspective. So it's more bottom up from a staples perspective, but in general, still prefer discretionary over staples.
Something you said right at the top, Karthik, do you think the market style has changed and it will stay changed through 2025, that high PE doesn't get rewarded? So no point chasing the previous winners. And so in that sense, it's an important point. Do you think that has already happened and it'll stay that way now for the foreseeable future? What's the sense?
I think it's too short. I mean, we've seen this over the last 10 days, and I think it's too short a time period to kind of conclude one way or the other. Because what we are seeing is in stocks that are reasonable, that have higher valuation but have delivered numbers, those stocks have bounced back strongly as well. So I think things will recalibrate post earnings, and where there is chance of earnings downgrades, to take a step back, if the earnings expectations is high and there is a remote chance of earnings downgrades, and those stocks and those sectors I think are more likely to be under pressure is my guess. But we still have to see at the end of the earnings season to see how it pans out. While this is in general, high growth and high momentum stocks have been kind of laggards or have been hurt over the last 10-15 days. But I think the market should start differentiating even within that group to kind of treat better some of those names that continue to deliver on their numbers.
Okay, got that. Karthik, final sense, we've spoken about what you like and where you're deploying. Where would you be taking profits from? I mean, for instance, in the EMS space, we saw that this week because valuations are so elevated. The slightest hint of a miss or, the slightest commentary going off track, and there was a big correction that crept in, but then there's buying also. So like that, which are the pockets where you think it's kind of done for now and it's time to take some money off the table?
Some of the areas where we've kind of reduced our exposure to over the last couple of months, to look at your question the other way, is some of the industrial names, some of the cap good names, and utility plays as well, where I've taken some weight of these sectors.
Okay, all right, Karthik, I wanted to ask you about cement. You know, we have gone through this phase. I'm looking at the leading indicators, whether I'm looking at cement, steel, credit card consumption, everything for January actually has not grown big time on a year-on-year basis at least. And now we're hopeful that we'll see some kind of action coming in the budget or from the government itself, as well as RBI could loosen things a little bit. If that's the case, the economy will revive. And some of these cement companies have not done much. What do you like from there? We had the leader yesterday, UltraTech Cement, extremely good set of numbers. How are you all placed on cement?
Personally, I still continue to remain right that if the government were to be proactive, both from a fiscal perspective as well as from a monetary perspective, RBI, then we might see a fillip there. But there can be other areas that we can evaluate in that scenario as well. And as of now, in general, the earnings environment, notwithstanding what you mentioned with respect to one particular company, still remains largely tepid in that space. So we'll still like to play all the themes that you mentioned through other sectors as it stands today. But if things do materially change and we start to see a pickup in underlying numbers, then happy to change my stance.
Okay. All right, Karthik, we'll leave it on that note. Thank you very much for joining in, and you have a good day today. Well, with that, thank you very much. With that, let's move on and get you more interesting voices from the World Economic Forum in Davos. Shireen caught up with Rishad Premji, Executive Chairman of Wipro, as he talks about Trump 2.0, AI upskilling, and also sounds optimistic on the business itself, saying 2025 will be a much better year than 24.
Joining me now is Rishad Premji. Rishad, always a pleasure. Many thanks for joining us here in Davos once again. You know, it's, as I said, this has been a Davos that's been largely dominated by 2 or 3 themes. Number one, of course, Donald Trump and what the US presidency is going to mean for the world. 2, a continuation of what we saw last year, which is AI. But the needle now seems to be moving towards it's real. What more can we do with it? How quickly can we move forward with it? And 3, India. You know, where do we find ourselves in the mix of the global uncertainty, and how much more can we draw in from the world? On each of those, let's unpack that, and let's start with Trump and what it eventually means as far as business confidence goes, spends for your sector, for instance.
Yeah. It's good to be back, Shireen. It's good to see you. This is our annual get-together, though I saw you in the middle of last year,
yes,
which was a treat. Look, I'm quite excited about what comes out of the US. I think, one, people like certainty and clarity. I think that's over after the elections. The new administration, I think, certainly talks about being very pro-business, pro-industry, pro-growth, which I think will unfold in terms of how regulation unfolds, how taxation unfolds. And so I'm excited about what that presents for our industry. And one is already seeing initial signs of organizations, companies coming out of the US thinking about that more purposefully. We'll also have to wait and watch what it means for tariffs and what it means for immigration, and so what it just generally means for inflation and how that creates some sort of a complexity in the unfolding of the pro-growth, pro-business agenda. But I'm generally quite bullish about the outcome of the elections from an industry standpoint.
Yeah, and I think that's what we're picking up in the conversations, the many conversations that we've had here. But you know, if I were to, that's the macro, but if I were to link that to the micro, and BFSI, for instance, I mean, everyone's now talking about the possibility of deregulation. What will that potentially mean,
right.
You know, in terms of their abilities to spend more? What are they going to spend it on? What are you hearing from the clients that you work with?
No, certainly, I've met a lot of our banking customers here, and they're certainly looking out for the deregulation. How that actually transacts will have huge implication. How much that actually translates into actual spend reduction on compliance, I don't think it's going to be as linear as the regulation reduction. But I think organizations, especially FS companies, are quite excited about just having less complexity and being able to get on with the business. So again, FS is an industry that's seen activity pick up towards the last half of towards the half of last year, and I expect that to continue as we get into 2025.
So 25 likely to be a better year than 24, significantly better, a little bit better? I mean, you know, what's your read?
I mean, it's just starting.
Yeah.
We've been a few weeks into it. I'm hopeful that, you know, we should see a better year than 24. I'm hopeful that discretionary spend should pick up gradually, but pick up as we move into 25. And I get great comfort in our specific case from our consulting business, right, which is highly discretionary, and they've had a good 24, and that momentum seems to be staying and sticking. So I'm looking forward to 25.
Well, speaking of 25, as I pointed out, the second big trend here is the AI conversation continues. It's now moved into from generative AI now to agentic AI, and the promise that that holds. I mean, your chalet here is also all about AI and talking about how AI can save you time and improve your life and the future and so on and so forth. You're obviously also betting big as far as this space is concerned, but how do you differentiate yourself? I mean, you walk down this street and everyone's got something to do with AI. How do you create a differentiator?
Shireen, we're focusing on three things, right? One, we're focusing on how do we operate better as a company. So how do we make AI all pervasive within Wipro? And we're calling it AI-powered Wipro. We're spending a lot of time skilling our people. So we've had 235,000 people go through a Gen AI 101 skilling, including me. We have about 50,000 people on higher levels of AI training, and they've gone through actual certifications, about 5,000 people at level 3 and about 500 people at level 4. And we're using that to drive a very strong mantra of think disruptively with AI first. And so we're changing all our functions, whether it be HR, finance, legal, sales, recruitment, skilling. And I'll give you a simple example, which I love, and I use this personally. We've introduced a simple bot into our HR organization to do everything for you, help you do everything from find your appraisal, apply for leave, figure out whether root canals are covered as a part of your dental policy, what your travel policy is, etc. They are in some cases. And so we've had 10 million queries in the last 12 months with 98% accuracy. Now we have a large shared services that supports this. That number will come down dramatically, but we're creating delightful experiences for employees who don't have to maneuver the complexity of the intranet to figure something like this out. So how do we operate better is becoming a very strong mantra within the company. The second thing is how do we deliver better? So the projects that we're already doing for customers, especially in the fixed price projects, how do we leverage AI to disruptively change the way we deliver? How do we infuse AI to drive differentiation there? And the third is how do we change the game for our customers, which means how do we bring very domain-specific, context-specific solutions for our customers. So for example, we've built something for FS customers called Wealth.ai. It's a dramatically strong enabler with human in the loop to help financial advisors be much better at understanding their customers, knowing their customers, having a full view of their customers, cross-selling, upselling. And you're seeing the benefits of that flow through with real customers. So this is not academic and sort of in POC mode. It's actually in production.
All right, let's get straight to our next management. We have Sona BLW Precision. As we highlighted earlier, the stock was down close to 6%. But take a look at what's happened on the screen. That dip has got bought into, and the street believes that maybe, in the longer term, the prospects could look up. Let's find out. We're joined by Vivek Vikram Singh, the Managing Director of the Group CEO at Sona BLW. Hi, Vivek. Good morning and good to see you in. Well, as I said, Q3 was a little bit soft. Q4, I believe there are still some kind of headwinds that are likely, to play out, and it could be a tough quarter. That's because of the model launch related transition for your key US customer. I think you mentioned that. So you're saying that growth will normalize in FY26. Could you tell us what kind of a growth should we expect on the base of FY25 and FY26?
Good morning, Nigel. That's a lot of questions rolled into one opening question.
No, so I just want to know what is the growth rate, Vivek, in FY26 in comparison to FY25? Give me a number, give me a range, I'll take that.
Yeah, but we don't give future guidance, but it'll be good. It's a fairly solid year, FY26. And even if you look at 9 months or YTD for this year, revenue is up 17% and net profit is up 19%. So, weak, yeah, but probably compared to our past performance, not really that weak. Even on a quarter basis, I think revenue is up 12% and net profits up 14%. Beginning of any quarter, if someone told me that you'll end up with double-digit growth, I would take it. FY26, of course, is considerably better. There is some bit of revenue that's actually shifting out in a way from Q4 to Q1 and Q2 next year because of the model transition that you rightly pointed out. So yes, as is our policy, we try to put bad news first. So whenever we have positive news, we probably take it slowly and conservatively, but negative news, we try to get ahead. I think that's what the stock has been reacting to, because for the first time ever, I think we called out that next quarter we expect to be weak, which is rare because, we've had 12 straight quarters of sequential growth.
Got it.
So it was unexpected, and I think we owe it to our shareholders to be fully transparent. And I know in a low trust society like India, honesty doesn't always pay in the short term, but we believe in the medium to long term, it will pay out.
No, the street is at least better prepared, Vivek. They know that quarter 4 is going to be soft, but as you're sounding quite optimistic about FY26. Let's focus on a couple of other numbers then. In terms of margins, because of the product mix, because of some softness in demand, margins were a little bit tepid. But going ahead, what is the trajectory on margins? If you could give us a number, what should we be working with in the coming quarters? And also, since we're just talking about revenues and the outlook looks pretty positive, on the base of FY24, I believe that by FY27, the revenue should double. You stick by that? That means you'll do around 6,200 crores of revenues?
Yeah, so every 3 years, I've been in this company for 10 years, we have managed to double or more. I think if we look at FY27 upon 24, we hope to be able to do that again. So that looks in line. On margins, see, we've been in the range of 25% to 27% for the last decade. We don't expect that to change. Mix can vary and swing from quarter to quarter, but if you look at a 3-year period, that's where it should stay. There is one thing, though, that I must add. That we acquired the railway business of Escorts Kubota. Now, whenever that comes in, that has a lower EBITDA margin. It has a net profit margin is pretty similar to what we have in our core business, but EBITDA margin is lower. So that may change this, but once we consolidate, we will know more about that. Hopefully, we have said September next year or September 2025, but hopefully we can close it earlier than that and try to start consolidating that bit too.
Vivek, good morning. Thanks very much for joining us, and it's nice to see a radiant, smiling face. Good to see that. So, just a couple of questions here. So there is, I think from the last time we spoke, we've got a new president in the US. I think we spoke about tariffs, etc. at that point briefly, right? Now, of course, we know that the man is there. 40% of your revenues comes from the North American market. How much do you, what you sell in the US, you make in the US, Vivek?
We do make some parts of it in the US. We also make some part of it in Mexico. 43% is our revenue from US as a geography or a market. But if you look at what we do for American customers, that number would go to as high as 60%, or American origin OEMs. So, contrary to what a lot of people believe, I think President Trump's administration will be really good for a company like us. Because if he indeed follows through on his promise of doing good for America and for American companies, that should be fairly positive. And I'll tell you the reason. Tariffs, we get confused in auto and auto components, I guess. The difference in tariffs between what US levies on Indian imports versus what we do for US imports is not very high. Depending on categories, between 5 to 10%. So even if reciprocity were to come in, given the current USD INR 5% drop, it is negligible impact expected. Second, the biggest import, $83 billion odd is what...
Sorry, Vivek, this is, it's for components it's negligible, you're saying? Because OEMs, I'm assuming it's very large, the disparity.
OEMs is a different story altogether.
Okay.
Yeah. So
but we are dealing with components, and since it's your business, so you're saying that's great to hear. Sorry, go on, I interrupted you.
Yeah, so if the auto import duties all over the world are to literally be equalized, which would mean US cars will start doing well in other markets and they can actually start exporting US cars. That would be actually fairly, very, very good for us. Okay. So we see this as a net positive, actually. And when you look at the import, like I said, $83 billion, Canada, Mexico, China are the big three from where the US imports its auto components. If they too have tariffs, frankly, India would be in the best bargaining position in this place.
Okay, all right. Yeah, Vivek, just assuming that 5-10% is levied, is it viable though, for a US OEM? Because I think their cost of production will go up much higher, right? So it may not be very viable, if you could clarify on that point. And also in terms of a Mexican plant, it supplies in Mexico only, right? So there won't be any negative impact if Trump puts some tariffs on Mexican imports. Is that correct?
So Nigel, absolutely right. I was just trying to answer that hypothetical that what if reciprocating traffic were to be put? I don't think they would, because this does nothing except raise the prices of US cars. So it's self-defeating in a way. I doubt they will touch auto components. It's a $1.5 trillion industry. There is a lot of outsourcing. It will make it more expensive only for US customers. So that would defeat the purpose. The Mexico plant, that was a good question. We do, or the initial intent we are launching next year from this plant, is Mexico to Mexico. That should be unaffected by this. But again, I think what we are missing, and Prashant, the thing we talked about was the EV policy. If they do away with the EV subsidies, that would be the single biggest benefit that a company like ours would get. Because that would mean that the American car market splits into two. One, the legacy players will focus only on ICE products, in which we have a fairly high share of ICE supplies. And the EV-only players will do only EV. The losers will actually be non-US car makers who make hybrid, because as you know, the subsidy, $7,500, also goes to plug-in hybrid and hybrid vehicles. The moment that goes away, hybrid sales should plummet and EV sales and ICE sales will increase, which is pretty much the best case scenario for us as far as the US market is concerned.
That's very interesting. And this calls for a deeper discussion, which we will do maybe outside of this sort of occasion when we talk about results, etc. Just one quick thing, Vivek. In terms of dependence on China for components and parts, etc., are you dependent at all?
Negligible. There is some permanent magnet import, some bits of semiconductor stuff, but that can be rerouted via Taiwan. We are actually net exporters to China. So we don't have that issue. I think we should look seriously at China as a market and as an opportunity. And frankly, that's what I would be focusing on in the next decade of my tenure. How to grow, not just in the West, but try to grow in the East also.
Absolutely. There's a big, huge market, bigger actually than the US.
Biggest market in the world.
Biggest market in the world. Vivek, thank you very much. Shorter conversation, but we promise to sort of invite you again and we can sort of go into some of the details of what's happening with tariffs and trade, etc., and how the market composition itself expands, changes. But appreciate your time here this morning. Well, time for another exclusive chat from the sidelines of the World Economic Forum in Davos. Sanjeev Bajaj, CMD of Bajaj Finserv, in conversation with my colleague Shireen, saying that liquidity line to NBFCs from the RBI will be a great confidence booster for the market. He also spoke about how the arrival of President Trump in the US may cause some uncertainty. Listen in.
Joining us now on the program is Sanjeev Bajaj. Sanjeev, many thanks for joining us here in Davos. You've been here for many years, but this is really in many ways a Trump Davos. What do you sense from what you hear?
So very clearly three issues that are relevant to us. One, the US economy surprisingly continues to be very strong. And that's one thing to take note of. Second, Europe continues to be in the doldrums, and they realize now that they've over-regulated themselves. That has led to slowdown. They have to cut regulations so that they can get competitive again. Third is, there is going to be a period of uncertainty with the arrival of President Trump. So you have to wait, you have to watch, you have to nimbly manage and be agile. I think the first 7 days, the first month, the first 6 months will be important. By then things should settle down to the extent that you at least know what's the unexpected to expect. And one has to plan on that basis.
The mood on India. We have, of course, seen things slow down a little bit. The hope is that as CapEx starts to pick back up, we will start to see an improvement in the second half. What are you seeing at this point in time?
Yeah, so firstly with CapEx picking up, especially from the government side, which is really what has helped us through the last few years as well, that should play a positive role after the monsoons. We are seeing some pick up on the rural side. Urban consumer demand is still a little slow. I'm hoping in the budget we see something to spur that as well.
What are you hoping for?
Very clearly when there is some slowdown on the ground, you have to find a way to get beyond that. So I hope whether it's some tax breaks for the middle class or at least the low middle class, some amount of reduction on excise duty on fuel will help prop it up. And once then it comes up to the right level, you can always readjust. So that nimbleness is required. So hopefully we'll see a little bit about that. Beyond that, the world is still very positive and very hopeful on India. They see us as a strong, stable partner. They have seen the positive work that has happened in India over the last decade and more. They know that, okay, maybe we are not as fast as some of these smaller economies which are very centrally driven. That's the positive, but then it has its own negative as well. But they do want to see us more competitive, more open to the world, not do anything retrospective, so that there is certainty. The more we can provide them confidence there, I think the greater the opportunity to bring more and more businesses into India to produce whether products, services, and export them, and for them also to get into the domestic market.
So are you starting to see now improvement as far as offtake is concerned?
So we are starting to see very clearly on the rural side. Urban, as I said, is still a little soft. We need to see improvement there.
And the concerns on what happened on the unsecured front, of course, the regulator put the speed breakers in place. Are things starting to stabilize there?
Very much so. So the regulator caught the delinquency is rising very early on. This was really small value unsecured loans. Tightened that. The delinquencies have started coming down. They are not down to their lowest levels, but they've started coming down. And but again, you have to be agile. So you have to know when to open up as well. Because within that consuming borrower, there is a segment that needs the money. If you're not going to give it to them as the formal financial system, they unfortunately have to go to the informal system, and that's worse. This continuous balance is required.
Well, speaking of additional measures, and of course, the hope is that there will be a rate cut by the MPC in February. Also, perhaps the need for more liquidity injection. We were at the CII budget town hall yesterday, and that is what was the ask, CRR plus repo. Is that the expectation that you're going in with as well?
Yes, liquidity is very low at this point, as you know, negative 2.5 lakh or so. We need to pump in greater liquidity. Second, liquidity is not really a challenge for the big banks. But you have to keep in mind that a large part of our system and our credit that goes into tier 2, tier 3, certain segment of society and below is NBFCs. And these are large NBFCs. Some of us are bigger than most banks. You need to make sure that similar kind of liquidity lines are created for us. See, NBFCs were not really in RBI's radar till 10-15 years ago. They are now. What they correctly did was created the layered level of NBFCs, brought in more supervision, brought in more inspection to make them more robust, completely understandable. But now give them those additional tools also to go and do their jobs.
What additional tools would you require at this point in time? What do you think is the need of the hour?
I think the single main thing is a liquidity line to NBFCs from the RBI. This creates confidence in the market. We know there are periods of tight liquidity. We can tap into that. It doesn't have to be a cheap line, but the availability of that makes a big difference.
All right. So the need of the hour is to create a liquidity line for NBFCs. That is the word coming in from Mr. Sanjeev Bajaj. And of course, I will keep getting you more from Davos as we go forward. Let's take a break right now. Coming up on the other side, get back to earnings. Mphasis will be joining in to talk about the third quarter performance and the outlook beyond. Welcome back. So the shape of the market now is down. We have not chosen to go along with Asia. There's no green here. It's a big sea of red, actually. Nifty's down about 25 points, but the cut is a little deeper in the mid-cap index. The mid-cap index is down almost 1%, and it's the bank Nifty that's leading the losses, down about 0.5%. But sticking with earnings, let's move on to the next company. Mphasis is on our radar. The stock has been reacting to the earnings fine print that came out. Revenue growth was a little below estimates, but deal wins have been pretty strong, as has been the commentary, and margins have been fairly steady. So to talk about the performance in the third quarter and the outlook, we have with us Nitin Rakesh, CEO, and Arvind Viswanathan, CFO at the company. Gentlemen, thank you very much for joining in. Good to have both of you on. I'm just going to start with the fact that the constant currency growth, Nitin, is just about 0.2%, and the market would have, of course, loved to see more. However, you are talking about record deal wins. So how does it tie up? Was it just sort of some seasonality that hit in the third quarter? And what's the outlook as we look ahead?
Sure. I think the deal wins are at about a 6-quarter high. Pipeline is probably at a record high, up 50% year over year. So I think what that tells you is that the pace of activity is definitely picked up in the environment and in the business, led by banking and TMT. So something we'd called out over the last 3 or 4 quarters as well. I think there's some work to do across some of the other verticals and geographies. US is definitely doing okay. We have some work to do in Europe, especially as we think, see recovery in BFSI back in Europe through 25. Pipeline, as I mentioned, is pretty strong. So are the deal wins. So good news is the order book continues to strengthen. Sequential growth obviously was a little bit impacted by the fact that this was a seasonally weak quarter, and we do expect to recover growth back in Q4 as we round out the year.
Okay, so it was just seasonality in the third quarter. Got it. Now, you've been maintaining that Mphasis will perhaps post better than industry growth. But help us with some sense of what that really means if we're talking FY25, because it's very, very different across different companies. There are companies that are managing to grow at 25, 30%. There are large companies that are barely doing 3, 4%. So, what should we understand by industry-leading growth?
Yeah, I think each company has a different, portfolio and a dynamic. Of course, for us, we are in a phase of recovering growth after a fairly tough, environment in calendar 22 and 23, driven primarily by, the deep cuts that you saw in, discretionary spend coming out of the interest rate cycle, partly linked to the portfolio that we've run. So good news is we've seen the recovery of that over the last 4 quarters. And as we define industry growth, it's really the weighted average growth of our peer group across all gap segments. Given where we are, given the remainder of the year, really Q4, that really means you're looking to grow above the single midpoint of the average growth. So basically,
and what's the weighted average, Nitin? What is that weighted average across your peer group?
At this point, the weighted average across the peer group is south of 5%. So I think if you think of that as kind of the baseline, for us the effort has been to grow above that number, and I think this has been a decent recovery in terms of the YY growth number. And as we pick up pace in sequential growth, you will see that pick up as well.
So you'll grow above means what? 1.2 times, 1.3 times? What should it be?
I think at this point, above is where we will be. We've stayed with that through the remainder last year since we started FY25, and we'll leave it at that.
All right, let's focus on margins then. You're currently in the middle of that guided band, but since your deal wins are good, you're going to grow better than the industry as well, and you have operating leverage that will play out. Do you think margins will gradually move towards the upper end of the band?
Arvind?
Quick update on the current quarter, right? So we did 15.3%, which is a marginal drop in a seasonally weak quarter. So we've been operating reasonably at the mid-range of our guidance, right? So that the reason there is a range is that we could operate at the both ends. And I think as growth picks up and, some of our investments pay out, I think, there is headroom for margin to tilt up. But we'll wait and see how it kind of unfolds.
All right. Okay, all right.
So just to, press you a bit on that margin front, I mean, the band is, I think, 150 bips, right? If I'm not mistaken. So as you're looking at a pickup in discretionary spends, which is what Nitin highlighted, what is happening on pricing? I mean, I don't know if maybe it's too early a question to ask, but when you talk pricing with clients, what's the feedback you get? Is there any elbow room to increase Maybe, in some geographies across some contracts, or none at all?
I think at this moment, yes, pricing is a reflection of competitive environment, underlying demand, but it's also a reflection of what segment of the market are you playing in. If you think about the forward-leaning approach that we've taken on a lot of the tech platforms, I don't think the primary issue that we have to deal with right now is the pricing, competitiveness. Yes, we have to be competitive, but I think clients are willing to pay for value. I think the primary rub right now is how quickly can you tap into the opportunities that are being presented by either the current AI adoption, or more importantly, areas where we do have an opportunity to become more competitive using AI. So I think pricing for us is we're in a comfortable position. We've seen fairly forward-leaning approach from customers as well when they see value. Focus right now is prioritizing growth. And I think we will continue to hold margins in that stable band. As we get into FY26, we'll give you further guidance on margin as well. But I think at this point in time, 100% focus really is on driving growth.
All right, the AI-led pipeline for you has moved up from around 35% to around 55%. So that's telling us a thing or two about your focus area. Another query that we normally wake up to in the morning, not very company specific, is what's the Fed going to do? And now there is a moderation in terms of expectations, because at the start of this year, you would have thought that maybe we'll get more hikes than what we're currently working with. But what if there is moderation in the Fed's rate cuts? How does it impact your business?
I think, again, it's predicting the bottom of any cycle, especially interest rates with such complexity in the macro, is very hard to do. So what we've tried to stay away from is build a plan or an outlook or a guidance based on where we think the macro will be. The focus has really been more on the micro front. What can we do with our existing clients in our existing geographies and verticals? And how do we really take opportunities that are being presented? And that's the way we've operated the business for the last few quarters since macro became uncertain. It's very hard to predict whether there'll be one more cut, two more cuts, four more cuts. I think anybody who has a good sense is really not 100% confident either. So for us, we've seen some impact of the turnaround in interest rate cuts over the last 3 quarters in the business, specifically in the mortgage segment. It stabilized a lot before that. If there is any additional activity that helps our business, I think that's the upside risk to where we stand today.
All right, just one quick question on your verticals. BFS revenue, that was up by around 8.5% on a year-on-year basis. And insurance as well did pretty well at around, I think, 7% growth. Do you see that growth number gradually moving to the double-digit mark?
I think that is the effort that we've been putting in. We called for a recovery in BFS as well as TMT for 4 quarters ago. I think we're inching close to the double-digit mark in BFS. If you look at our direct BFS growth in Q3, it's almost 10%. So we are fairly confident that recovery will continue to pick up pace purely based on the deal activity and the closures we've seen as well. So I think good place to be. And as I mentioned, right, if macro turns more favorable, there is upside risk to that number growth from a growth standpoint as well.
Finally, Nitin, can't let you go without asking about AI and what that's meaning for your business. I think from what our colleague Rima was telling us, the pipeline is at about 35%. In Q2, it was 35%. Now it's at 55%. Can you tell us how that's contributing overall to the revenue and what's the trajectory?
I think the phrase we've used is AI-led. What that means is that a number of opportunities get opened up because you have the ability to use either an AI platform, third party or our own, to actually bend the cost or the efficiency curve, and in some cases create an ROI that probably wouldn't have existed without it. So it's a fairly good place to be. I think the last 2 years since OpenAI launched ChatGPT, there was obviously a fairly high degree of interest at the enterprise level from an adoption standpoint. We are starting to see the pace of adoption really pick up. And I think 25 will definitely be a good year from that perspective. What we are doing is bundling that into a number of our solutions. And that's leading to growth in pipeline. That's supersizing deals as well, actually. And ability to then drive closure is also getting fairly clear. So that's one of the reasons why you've seen a pickup in TCV numbers for Q4. For Q3, we've also announced an additional 100 million plus large deal in Q4 already. So I think that's a sign of things that hopefully point to a resurgence in deal making through the remainder of 2025.
Okay, all right, gentlemen. Appreciate you all stopping by, giving us details with regard to how you see business shaping up, and also sounding reasonably optimistic about growth for FY26. Look forward to having a chat with you all in the next quarter as well. Well, as we were having that chat, guys, just take a look at the Nifty. It's down close to around 65 points, and a few stocks that have slipped. SBI Life, that's moved to the low point of the day. You know, you have Trent as well, that's coming for some selling pressure. And the normal suspects, you know, from the broader markets as well. You have stocks like Kalyan Jewellers, well, that's moved down yet again. It's down another 2%. I saw that, you know, Suzlon had a bit of an uptick in initial trade, but that's got sold into as well. So that comes up for you on the screen. So a little bit of nervousness is what we're seeing in the broader markets. Even Z Entertainment, it started off in the green. That's sold off. And Zensar, that did well yesterday, that as well has moved to the low point of the day. The pressure is in the broader markets. The headline index is down only around 60-70 points. But the pressure on the broader markets is something that's telling you the kind of nervousness that we're seeing. But yet again, as I say, a lot of these stocks have come to pretty decent valuations from the broader markets. You need to pick and choose the ones that you want to get into. Let's find out how do you trade the technicals though. Mitesh Thakkar joins us on the show. Hi Mitesh, what do you make of today's initial trade? Do you think that the trend is still on the upside? Would you look to buy this dip, or do you think the markets are seeking lower levels? So you believe that in fact you'd rather not buy the index, and also fill us in with your trading picks.
Yeah. So I think the market hasn't yet given any big sign of a reversal. So not buying the index on this dip, I'm not sure, whether we are looking up or down. We are in the middle of the range of 23,000 to about 2350. Practically going nowhere. So just wait it out. On the stock side, I think, there is some kind of a negative movement which has happened on the chart of Syngene. That's a breakdown over here. On a mild pullback, say around 780, 790, sell with a stop at about 811 for targets of 750 to begin with. We might actually see much lower levels than that as well. So that possibility is open. And UltraTech Cement is a buy. Keep a stop at 11,150. Look for targets of 11,850.
Got it. We'll keep an eye out on that. Thanks a lot for that, Mitesh. For the time being, we'll slip into a short break. On the other side, we'll focus on some stocks that are on the move. Stay with us.
Welcome back. Let's take a look at a couple of stocks that are on the move. Rima is joining in to talk about the huge disappointment that's playing out on Cyient. Numbers not good, plus management change. Rima.
For Cyient, there are two key negatives, as we pointed out in the morning. One is the guidance cut. The company has lowered the guidance on revenue and margins. Now, for the full year, they're penciling in a growth of minus 2.7%. This was on account of right shifting of projects. And secondly, on margins, they were hopeful of exiting the year with 16% margin. Now, on account of aggressive wage hikes, the EBIT margin guidance for Q4 stands at 13.5%. So that's disappointed the street. And secondly, the CEO, Karthikeyan Natarajan, has stepped down in a span of 20 months versus his term of 36 months. So that came in as a negative surprise. That said, the management commentary was fairly upbeat. Now, brokerages are quick to respond to this. JP Morgan today has downgraded the stock to a neutral. But that said, there were a few positives in, the outlook from the conference call. One, the management said that this guidance of minus 2.7% for the full year, in a way, is the worst case scenario. It may not be as bad as that. So that's point number one. The guidance could be on the conservative side. Secondly, the company did see record deal wins in Q3. And also, the company is calling out a recovery from Q1 onwards following the strong deal wins. IFL, on the other hand, maintains a bullish call on Cyient on account of inexpensive valuations and a potential recovery. So they're saying the stock is trading at 21 times FY27 PE, relatively inexpensive, and therefore they have an add rating. But the risk is that the potential recovery does not take place. There are delayed ramp-ups which hurt the company.
Okay, all right, got that. Explains the 19% decline on the stock that we're seeing right now. Rima, thanks for it. Let's quickly move on and look at Mankind Pharma. Even here, the numbers have not exactly hit the mark. Vinny, share the details with us.
Absolutely. So in terms of Mankind Pharma, what we're seeing coming in, it's not a great show coming in. We're seeing a red that is expected as it was expected because Q3 numbers were just slightly in line with estimates. Let's not compare it on a year-on-year basis because there was a BSV integration that came in October 2024. So because of that, year-on-year basis, it's not something that we'll compare. Now, what didn't do well was the profits of the company saw a sharp decline because there was an increase in finance costs. Finance costs was at around 221 crores versus just 9 crores. And this is increase in terms of the debt that is coming because of the BSV integration that has taken place. Other than that, domestic sales were somewhere around decent growth when you look at it, but revenue margins, nothing exciting on that front, and margins also have remained quite flattish. So that is why Mankind Pharma was something that is seeing a fall in this stock.
Okay, all right, got that, Vinny. Thanks very much for that. Let's take a break on that note, come back on the other side, and we'll have our special segment Budget Countdown coming up. Lata will be in conversation with Kulin Lalbhai of Arvind and Siva Ramakrishnan Ganpati of Gokuldas Exports to discuss what the textile sector can expect from Budget 2025.
Hello and welcome to our Budget Countdown special. In this edition, we are looking at sector-wise demands. Today, it is going to be textiles, the sector which employs the maximum number of people after agriculture. The government notified a PLI scheme for textiles in September 2021 with the intention of promoting more man-made fiber, apparel and fabrics and products of technical textiles in the country. The scheme elicited in its first round 74 applicants, envisaging about 28,000 crore in investments, aiming for incentives from the government to the tune of over 7,000 crore. But now the industry wants more sectors like garments to be included in PLI. Of course, there are more demands. To get a complete overview of what the sector wants from the government, I have with me Kulin Lalbhai, Vice Chairman of Arvind Mills and also Chairman of the Gujarat CII. Also, Shivaraman Ganpati, the Vice Chairman and Managing Director at Gokaldas Exports. Gentlemen, good morning. Thank you very much indeed for joining us. Kulin, let me start with you. You speak for the industry as a member of the CII. Have you all sent something to the government? What is the ask from the budget?
Yes, great to be here, Lata. And, this sector obviously is a very high priority sector also for the government. And over the many years, we have been extensively working with the government on various schemes and ideas and support that the sector requires, and happy that things like PLI and the Mitra Parks have happened. But coming to your question around what is required, I think the opportunity, first of all, if we look at it, I think the geopolitical opportunity for India is extremely attractive as far as our sector is concerned. Everyone is moving away from China, which controls 35% of global trade, and even the geopolitical challenges of Bangladesh are a positive for us. So this is the time to really accelerate as far as our sector is concerned. And the core part of this business that needs to scale is the garment sector. That is the last mile in a sense. And our garment sector is very small compared to the opportunity that our country has at $15 billion exports. And we can double that number, in not too much time. And that's where one of the asks that we have is, can we have a more broad-based PLI, where in addition to the man-made garmenting, if we can expand the PLI to all the HS codes in garments, then the segments which we are strong at, which is, say, the cotton garments, can see a huge boost in a short period of time. So I think any capital deployed towards supporting the garment sector and making the PLI more broad-based can go quite a long way for quick scale-up.
Okay. And just coming back to you for other demands, I would assume that there will also be requests on taxes. But Mr. Sivaramakrishnan, from the point of view of someone running a big export company, what's the expectation from the government?
Thank you for having me. I think as Kulin Bhai said, the sector is vital for the economy as well. And I think our endeavor should be to create a vibrant Indian manufacturing industry, that's export oriented, anchored by globally competitive players with technology, innovation, scale, and above all, an audacious ambition of being world leaders. From that perspective, the current macroeconomic environment is very, very conducive because there is a move towards relocating some of those manufacturing towards India, China falling out of favor, so to speak. There are issues in Bangladesh. So all of that augur well for us. And from that perspective, I think what we should be doing in the country is to really induce industry players to invest in capacity creation. And the policy should help reduce risk for them to invest in capacity. So I'm hoping that apart from the PLI point, which we talked about, which Kulin Bhai talked about just now, we also really need to, strengthen this PM Mitra Parks. I mean, today, there is a scheme and create to create an infrastructure, but maybe that infrastructure should, be reimagined to provide sustainable operations within that PM Mitra Park. For example, can we create a ready-made infrastructure supported by 100% renewable energy, net zero water consumption, carbon neutral operations, waste management facilities, etc., which allow the country to, offer something which is not very readily available in other regions and which is really in demand from global market, and which will be the trend in the future. So if you look at it from the next 10, 20 years, that's the way manufacturing will go, and we will be, in that right direction, and any further investments will augur well for the foreseeable future. Further,
there is a PM Mitra Park in Tamil Nadu, right? It is not working to the expectations?
No, there are PM Mitra parks in several other states as well, but these parks have just been notified. So the parks have to be created, infrastructure has to be created. But what I'm trying to say is that, can we envisage something bigger out of the park? A sustainable park, which then makes us really competitive, vis-a-vis other areas in the world. So that's what I was trying to say, and it means that we may have to do a little higher level of investment. This is one apart, the PLI is the other one. And then the other thing I feel is that, we need to get more labor available for the industry as well. And I think women is a big, labor pool for this industry, and we need to have policies encouraging more women to join the labor pool. So today, for instance, there are lots of incentives for women in general, and we probably should look at how do we incentivize women who actually take up more jobs, formal jobs.
Yeah, I just want to rush in on taxes as well, because budget, women and PM Mitra and PLI usually come even outside the budget. But Kulin, are there, taxes is what you look at in the budget. Is there any specific ask?
Yes, there is one very specific ask on this, which is that, India's raw material competitiveness is coming under a challenge. I think the three main raw materials in this business are cotton, viscose, and polyester. And unfortunately, we are amongst the highest costs in all of these three raw materials because we have import taxes in the upstream part of our value chain. So one of the recommendations is that we should remove duties which are in the upstream so that the value addition in our industry can go up and we remain raw material competitive. Because this is the time that if we are very competitive in the value chain, we can take market share away from our competitors, but we cannot have our raw materials being the most expensive.
But for exports, you get a set-off. It is the local production that suffers, right, if the duties are high?
Two things that are, usually we have certain schemes like RODTEP where we get back embedded duties on exports. Now, whenever you do an advanced license, you do not have all those RODTEP advantages and you still end up then having other types of embedded duties outside of the raw material. So unless we make the raw material competitive in toto and not just on advanced license, we will keep a handicap. Secondly, the domestic opportunity is also very large. And one of the things very rightly that the government has identified is that India has to scale on man-made. It is 60% of the global trade, and we have a very underdeveloped industry. One of the reasons the industry is underdeveloped is that, we are the most uncompetitive on the raw material side. So even if we are great at spinning or great at weaving, we are not able to create a product on the same price parity as a China or a Taiwan or a Vietnam. So I think we do really seriously need to look at, across the value chain, where do we focus on local value addition? Where do we have a level playing field on costs? And, finally, unless we are competitive, the man-made fibers will not scale up.
Yeah, no, very cleverly correctly, the government introduced the PLI schemes in man-made fiber, recognizing that that's where the export demand at least is. Mr. Shivramakrishnan, you spoke about skilling. The National Skill Development has been able to do anything. Also, last year, the government announced some employment schemes where they said that they will bear the EPFO or ESIC costs. The rules have not come. Will that make a big difference if they just implemented what they announced in the last budget?
See, every implementation goes a long way, right? So if that gets implemented, it helps the industry, especially from an employment creation. Expanding upon that will be required because we are talking of creating a fairly large employment in this sector. So anything which can further bring, and what we are saying is that let the advantage go to the employees or the workers, and that will encourage them to come in larger numbers, participate in the workforce growth. Today, I don't think demand is a constraint. It's actually capacity. So, how do we corral capacity and create that workforce? So that's a very good position to be in. And if we are able to encourage more people to come work in the, core areas, clusters where this industry is thriving, I think that will go a long way in, doubling the apparel industry output from an export standpoint.
Okay. I was reading some expert features on the textile industry itself. Kulin, there was a point made that, when it comes to electronics, we have the big giants, say LG or Samsung or some big companies investing in India. We don't have textile giants coming in. So is that also an ask in the FTAs? I don't know how much of it is budget relevant, but both on skill and large companies, any further asks?
No, I think, there is definitely an opportunity to get some of the largest garmenters in the world to come and invest in our country as well. The Taiwanese have invested heavily now on the footwear side, but have not come to the country, and they're leaders on the MMF garment side. We can get people from Vietnam and other countries also to come. And for that, plug and play infrastructure, wherein it's easy for a global company to come and manage both the labor and the infrastructure side. That is required. And that's where Shivaji was also saying that, if we are able to accelerate the Mitra rollouts, you have 7 parks of 1,000-acre plus with world-class infrastructure. We should, once in place, definitely we can look to attracting some of the majors on the FDI side. Also, the second big piece which you mentioned may not be directly a budget item, but the FTAs with the West are a huge unlock for us because it's an 11% duty disadvantage India has with the European Union and the UK versus Bangladesh and Vietnam. And now that's a huge disadvantage for an industry like apparel. So any FTA can go a very long way in accelerating the growth of this industry.
Okay. Well, point taken, Kulin. Let's see how much the industry is able, the budget is able to grant. Shivaram, I did ask you about taxes. Did Kulin cover everything or anything more in terms of taxes that or duties that you would want?
No, I think Kulin has covered everything. From an export, as an exporter, I know we don't really contend with it. But there are schemes like ROSCTL, etc. If there is a long-term visibility to it, and it's announced for say 5 years or thereon, then it'll go a long way in giving the industry a comfort that the policy is in place for a long term.
Okay, fair enough.
There's one point I would like to bring, which is on the domestic side of the economy. See, one of the biggest advantages India has is the size of its domestic economy. In the apparel side, it's $100 billion market size. It's double of our export business. And looking at India, it has the opportunity to grow at 8 to 9% a year, just the domestic market. And I think it is very important that the animal spirits of domestic consumption are maintained. And towards that, I think any move to put more money in the hands of the customers, either through a cut in direct taxes or anything to ensure that indirect taxes such as the GST slabs, we should not change GST slabs or create complications there. In fact, simplification and lowering of taxation can go a long way. And as Shiva said, this is an industry that can add 1 million jobs a year. That's, a little more 10% of what India needs. So I think if we also ensure our domestic market stays chugging, it will create a lot of jobs, a lot of women jobs, a lot of organized people moving from the farm to production. So it's a huge virtuous cycle. So we should also ensure we stimulate the domestic demand.
No, you're speaking actually to this entire viewership that's watching and listening to you. A little more encouragement or SOP to ensure that consumption improves since, in the second quarter, the GDP numbers showed that. More recently, Hindustan Unilever numbers showed that there is a slowdown or stagnation in urban consumption, which could get some encouragement with tax incentives. That's the big ask anyway from most industries. Mr. Sivaramakrishnan and Kulin, pleasure speaking with you. Thank you very much. We will, of course, invite you for your individual companies in a bit. For the moment, this is a budget discussion. Thank you very much indeed for joining us. Well, that's the ask from the textile sector. Import duty cuts, PM Mitra Parks, PLIs, as well, just spur domestic consumption. That seems to be the ask of so many people. Wrap up on this budget edition after a break, Chartbusters. Can I start? Oh yes, spurring consumption. That our viewers will be able to sympathize with. Thank you very much, Kulin Lalbhai and Shri Ramakrishnan Ganapathy, for putting on the table the key expectations from the textile sector. We have to take a break on that note. On the other side of this budget countdown special, we will be in conversation with Devshankar Tripathi of Aadhar Housing Finance and Mahesh Mishra of India Mortgage Guarantee Corp on what the budget can do for the all-important housing sector. Can I start? Welcome back to our budget countdown special. In this edition, we are going to look at sector-wise demands. At the moment, we are with the housing sector. The budget approaches housing from two ends. First, it provides tax exemption for interest and principal payments towards a home loan. On the other hand, the second incentive, it provides housing for economically weaker sections through the PM Awas Yojana, both urban and Grameen. Since its inception in 2015, the government has sanctioned over 4.2 crore houses. In June 2024, the scheme got extended for a further 5 years with a target of 2 crore more houses. The total expense for the central government over these 4 years is approximately 4 lakh crore, which works out to around 40,000 crore per year for PM Awas Yojana. What more can the government do? What's the ask of the industry? I have with me Devshankar Tripathi, the Executive Vice Chairman of Aadhar Housing, and Mahesh Mishra, CEO of India Mortgage Guarantee Corporation. Gentlemen, thank you very much for your time. Mahesh, let me start with you. First up, tax incentives. We know 1.5 lakhs for interest and 2 lakhs for principal. Any further demands on that? Thank you. Actually, he's sitting in the studio.